Now I'm going to introduce David G., and that's who we're going to be talking about going forward. Who is David G.? What I decided to do when I put this presentation together is I put together something that is what everybody can do, because what we tend to run into many times in presentations is the presenter says, here's what you can do, okay? But they don't go into how do you do it, or what is the direction for me to look for. So what I decided to do in this presentation is we're going to talk about, to some extent, where we have what you can do, and here's how a person who is a real live person did it. And they didn't just do it in such a fashion that you can read about the guys that bought, or the people that bought one property and made themselves their $1 million and they got, their very first deal. Well, that's all well and good, but if I had to pay my bills on that particular story, I don't think my bills would have been paid the last 40 years. You pay your bills by hitting singles, couple doubles, and then you knock occasional home run. And that's how you really pay your bills in the real estate business. Anything other than that is something that you just hope for but don't count on. Now, David G. in 1996 was a 50% owner in a fitness studio. In 1998, his father gave him a Carlton Sheets course. Now, Carlton Sheets is not on the TV as much as he used to, but he had a course for $199, and it's I actually believe this course is a great course. It covers a lot of stuff. It doesn't go into an extreme amount of detail, but it certainly is enough to get you curious about the real estate business. And so that piqued his interest in investing. So in 1998, David didn't waste any time. He purchased his first rental duplex for $87,000. Now, since he could not get financing, he did not qualify. He didn't have any verifiable income, and his wife didn't have any verifiable income. He used his credit card to cover the $10,000 down payment, and he got owner financing, because that's one of the things that was mentioned in the Carlton Sheets class. So he buys his first duplex with a credit card, and I became aware of David because he did a couple of conversations or minor lectures on using a credit card to finance real estate. It's not a recommended procedure, but it worked out in this particular case. In 1998, he purchased his primary residence, which was owner financed. And up until this point, David had the rental duplex, but he did not have his own personal residence. They were renting. From 1998, from 2000, David purchased 10 properties incorporating a buy and hold strategy, mostly owner financing. He said that he didn't really get any kind of bank financing. He was able to get commercial financing on a couple of the last deals that he did with the buy and hold strategy. He liked the buy and hold strategy, which, by the way, is this cornerstone to great wealth. And there's some great material on that. We could talk about it at a different point. But David G. said that when he got to the point where his properties were taking too much time, his buy and hold strategy in 2000, because you got to remember, he just started in 98, 97, 98 doing this. So he bought these properties. Well, they don't cash flow. This was in 98. This isn't in 2012 where you've got properties that you can buy and have them cash flow. So he didn't have any positive cash flow, and his business was doing marginal. So he discovered wholesaling, which we're going to get into in a second. But one of the quotes that he said that about wholesaling, he says, David G. said, when the wholesaling dried up, the rental income from my buy and hold properties is the thing that kept me afloat, as opposed to leaving the business because you could no longer flip properties. And if you're prior to 2008, you'll understand perfectly what I'm talking about. If you're not, in 2008, financing dried up, so the wholesaling business dried up to a large extent, and then now it's being done in a slightly different fashion, still successfully, but a slightly different fashion. So in 2000, he I mentioned the non-payment of tenants and repairs, and David listened to a national expert on wholesaling, and a month later he purchased his first flip. So from 2001 through 2005, he was purchased 5 properties a year, maintaining his buy and hold strategy, also incorporating wholesale. So David adapted to the situation. In 2003, he closed his fitness studio. And as a background, this is all important because you need to understand that David is a smart guy, as everybody that's listening to this is. Otherwise, they wouldn't be taking their time to learn this. But he's not a 227 IQ. He's an average, everyday person. He's got a college degree. He worked in retail when he came out of college. He didn't like that. Didn't have any money. As I mentioned earlier, he used his credit cards to finance his first real estate transaction. He had absolutely no real estate experience. And I didn't make this stuff up. These are actual quotes to some extent that I've gleaned from the conversation with David, but he joined a local real estate investors club to increase his knowledge of real estate investing through the various educational opportunities that these organizations offer to their members for minimal annual fees. For $100, $150 a year, you have unlimited meetings. You have unbelievable opportunities to interact with other investors, both beginning and experienced, and you have educational opportunities. And you'll see why the education is so important as we move forward in these presentations. When did David open his IRA account? Now we're going to get into the transactions. In August of 2005, David G. opened a self-directed account. He had heard about self-directed IRAs through a seminar that I did. He opened a self-directed Roth because he wanted an account that grows tax-free, allows for future distributions that are tax-free forever. The one thing you got to understand about a Roth, once it's qualified, it's tax-free forever. He funded his Roth IRA with a direct, non-taxable transfer. Many people say, is there any consequence to me transferring from my current provider to a self-directed account? What is sometimes overlooked is they're the same account. We do the same job as the securities industry, except we allow you to invest in different type of assets as opposed to just securities. So they did a non-taxable transfer from 2 previously established Roth IRAs in the amount of $6,800, $3,800, and $3,000. That was his funding for the account. Now, why did David G. wait until January 2007 to open his first directed account? It was simple. David G. had lost his confidence in the Wall Street. And even though he didn't have an investment picked out at the time, he opened his account. He had confidence that he would find a worthwhile future investment to direct his retirement funds to. What you have to consider is that when many times what we find is that the client says, well, I'll open an account when I find something. Well, if you wait till you find something and you find a very, very good deal, there is a time frame to open these accounts. We can do it very quickly. However, getting the money from provider A to us does take time, anywhere from 1 to 3 weeks, and sometimes in some cases longer if they drag their feet. So you've got to be prepared to make the investment, and tripping over a couple of pennies of perceived return, maybe interest, that you may think you're going to get, or the stock market, hopefully it doesn't go down before you make the move, then as David G. says here in his next paragraph, he says, he also felt like entering into a new area of investment is something that the first step to carefully, like a first date, okay? You're introduced to the person, you know you'd like to go on a date with, you set the date in advance. You're not worried about getting married. You just want to get to know this person. What's a similar situation when you're going in any kind of venture? And then you educate yourself about the relationship. In this case, that relationship is with self-directed IRA investing in whatever you choose to do, whether it be real estate or some other asset. You move forward only after you discover that this is a match made in heaven. And when you discover the power of self-direction, the power of compounding, and the power of tax-free money, if you have a Roth coming out at the back end, then you move forward fast. And David G., in fact, did move forward fast. And here's his story. Deal 1. And this was January 2007. By the way, I should tell you there are 30 of these transactions that have occurred between January 2007 and February of 2012. We're getting ready to close a transaction for him, or believe we just closed it. His first one was a land banking transaction, and land banking for you is it's a fancy word for buying land with the idea that it's going to go up in the future. Now, this is a very simple first transaction because David felt, and I do too, is that, you know, you don't have to be horribly creative to make money in the real estate business. You just have to be persistent. Do something that's clean and neat, get it done, and move forward. Waiting for the grand slam, you could be waiting forever. David G. found a great first purchase. It was an oversized residential lot. Now, remember, this is back in 2007, before the economic downturn in 2008. So these numbers at the time, you know, going up or down, it doesn't really matter because he still owns the property and plans on keeping it. It's a great piece of property in the Asheville area of western North Carolina, which is in the mountains. It was $18,900, and the maximum market value at the time was $31,000. Those numbers may sound small to you, but those are the actual numbers. I had water, sewer, had a phenomenal view in the mountains. You know, the view is worth a lot. And then the additional upside potential to split the lot into two parcels. David G. stated, I wanted to test the water. This is his quote. I wanted to test the water with an easy investment. Land was a good choice because it requires very little management. Okay, so he made his first purchase. Now, he only had $6,800, so how did he buy a $18,900 piece of property? If you've been following the numbers, you may want to ask, is in 2005, he made his original $6,800 contribution. In 2006, he made a $4,000 contribution, which at the time was the maximum he could make during that year. And in 2007, he partnered with his Roth IRA, giving her Roth a 50% ownership interest in the half of the price, not including closing costs, was $9,450. Now, I want you to make a note. David G. partnered with his wife's IRA, her Roth IRA, which is also a tax-free vehicle, for a long-term hold to make the purchase, even though he cannot purchase. Remember we talked about prohibited transactions? Even though you cannot purchase from the wife or the husband or entities they own or control, children, parents, or other disqualified persons, is what I'm covering here again, he can partner with himself or any other persons at the time of acquisitions, whether it's an IRA or otherwise. So he can do that, as can you. So if you don't have a large account, you can still do a transaction by partnering up with somebody else and or your wife or your I should say your spouse as opposed to your wife. And the title is, as I mentioned before, I wanted to reiterate here that it's American IRA LLC for the benefit of David G. Roth IRA, an undivided 50% interest, and American IRA LLC FBO, that means for benefit of Mrs. David G. Roth IRA, an undivided 50% interest. So that's how the deal structure went together. Now, there's some other things that we want to cover to make some clarity on how this is affected by owning it in an IRA. The warranty deed is held in by American IRA in a fireproof safe, and the reality is, of course, that that's a recorded document. 50% of all expenses for the land are paid by David G's Roth, and the other 50% is paid by Mrs. David G's Roth. The individual, these are the things that need to be really clear on, so I made sure that we put these in these case studies. The individual is not allowed, David G. and his wife are not allowed to pay the expenses for the IRA or receive any income from the IRA. The IRA must take responsibility for the portion of the expenses and or income in exact relationship to the percentage the IRA invested in the purchase of that asset. In this case, 50%. So for example, you can't buy something and say, I think I will pay most of the expenses and then shift the income over to the other partner, whether it's an IRA or otherwise. You can't do that. David G. and his wife, parents, or entities they own or control are not allowed to use the land. Remember, we talked about the prohibited transactions. So you can't provide goods, services, or facilities. So David G., his wife, his children, his parents that are prohibited are not allowed to use the land. For example, camping, picnicking, walking the dog, or storage. My feeling was this was an absolutely perfect example of some of the simpler things that you wouldn't even think about that relate to the prohibited transaction. The IRS states the asset owned by the IRA must be for investment purposes only. Now, the question you're going to have in your mind by looking at this is, who knows that the IRS doesn't watch to see if they're walking the dog, camping, parking, picnicking, or on this land. They don't do that. Okay? Fair enough. However, the penalties are so high if you make a mistake that because they don't police it, that it could be as high as, for rounded numbers, 160% of the principal of the IRA. So when you're thinking about all these wonderful ways to do this, just keep in mind, just do it a very simple way that is non-prohibited. Don't try to skirt the rules. There are so many ways to make money in the real estate business and other businesses. You don't need to skirt the rules to take a chance on disqualifying your IRA. On that same vein, David G. hired someone to clear the land as needed. Neither David G. nor any prohibited persons are allowed to provide goods or services such as clearing land owned by the self-directed IRA. Very simple, straightforward, but many times overlooked when something in a scenario like this. David G.'s IRA obtained a liability policy for the land to protect from losses in the event someone entered the property and injured themselves. While this is not a requirement of the IRA, it is always just a good idea to insure yourself against potential financial loss. As a reminder, this policy must be purchased by and in the name of the IRA, not the account holders' names, which we've talked about. So, as I mentioned, each one of these transactions have their own little items that crop up that have to do with both A, real estate investing, and B, how is it affected in the IRA. And I'm fairly certain that making the translation from prohibited person to clearing the lot was not the first thing that you guys thought about when they bought the land. But it is something that needs to be considered in every transaction inside of a self-directed IRA.